Hi everyone, welcome back to my channel. Today we're going to talk about our DCF analysis of a fictitious company that I've created, which is Aurora Coffee Corporation. This is the information that is provided. So what we're going to do is we're going to look at the base year assumptions and do the forecasting of the income statement for the next 5 years based on the information provided in the case study. And then we're going to discount the free cash flows to be able to calculate the enterprise value. So we're going to do it step by step. So let's just have a quick read through of the case study. Aurora Coffee Co. is a rapidly growing premium coffee retailer planning national expansion. Management is evaluating whether to accept a private equity investment or continue expanding independently. To assess the company value, analysts decide to perform a discounted cash flow valuation using free cash flow to the firm. Free cash for the firm is the money that is left over after the company pays for all its expenses, do the investments to sustain the operations, and also investments to grow the operations. Whatever money that is left over and that belongs to both debt and equity holders is called the free cash flow to the firm. We're going to look at the formula and the Excel sheet for the free cash flow to the firm. It's an absolutely most crucial concept in investment analysis. Baseline year assumptions are given as follow. Revenue is going to be 15 mil. Cost of goods sold is going to be 30% of sales. SG&A is going to be 45% of sales. R&D expenses are negligible historically, which we're going to be assuming that it was zero for the baseline year, but it's going to be 1% of sales going forward. Depreciation is 600,000 for the base year. CapEx is 4% of sales. Tax is 25%. Net working capital increased by 300K. Management forecast the following revenue growth is going to be this, but this is crucial. Long run perpetual growth after 2029 is going to be 3%. So if we do it for 2025, 26, 27, 28, 29, 2030 is going to be our terminal year. So I'm going to assume that 2030 is the terminal year. What are the assumptions going forward? COGS are going to remain 30% of sales. SG&A is going to decline by 1 percentage point per year until reaching 40% of sales. R&D is going to be 1% of sales. Depreciation will equal 80% of CapEx. CapEx remains 4% of sales. Change in net working capital is going to be 2% of change in sales. So we're given the WACC, which I've covered in our previous topics. If you want to learn about WACC, you can go and watch my previous video. Terminal value estimated using Gordon growth model, which is a growing perpetuity formula. Aurora has cash of 2 mil, debt of 6 mil, and the shares outstanding of 1 mil. Find firm value as of 2024. So let's go to our Excel sheet. So I mapped out all the assumptions here so we don't have to go back to the Word document. We can just work with this information, but yeah, we need the revenue for 2024. So the revenue for 2024 was given to us as 15 mil. Yeah, that's 1.5 mil. Okay, so revenue is given as 15 mil. That revenue is going to grow at these growth rates going forward. So I'm going to do equal to this multiplied by 1 plus 18%. We're going to move that to the right. Shortcut in Excel is you can press the shift key, highlight the right cells, and then do Control plus R. Cost of goods sold is going to be 30% of revenue. Okay, and I'm going to multiply with -1 to make it a negative number. All the costs are going to be represented by brackets, which denote the negative sign. So gross profit is going to be revenue plus cost of goods sold. The shortcut on Excel again is Alt plus equal to find the gross profit. Okay, so we're going to proceed. We're going to say SG&A. If we go back to the case study, in the baseline year was 45%, but in the future we said it's going to constantly decline by 1 percentage point per year until reaching 40% of sales. So 45, 44, so it's going to be 45 in 2024, 44, 43, 42, 41, and then remains at 40% for 29 and 2030. Again, the calculation of it's pretty simple and straightforward. Revenue times the SG&A multiplied with -1 to denote that it's a expense. R&D was negligible. So if I do this times 0, which is going to be 0, but that way I can at least use the formula going forward, right? One mistake I made is I got to make this a -1 to denote that it's a cash outflow. Okay, so now EBITDA is going to be simply gross profit plus the sum of these two expenses. So this is how we can calculate EBITDA. Okay. Moving forward, depreciation is going to be, okay, so let's look at depreciation. Depreciation equals 80% of CapEx. And CapEx equals 4% of revenue. So what we're going to do is we're going to first calculate our CapEx, which we're going to say is going to be the revenue times 4%. Okay, that's what our CapEx is. And let's denote it by a negative number. That's what our CapEx is going to be going forward. Depreciation for the base year is 600,000. That's given to us. Okay. But going forward from 2025 onwards, depreciation is going to be 80% of CapEx. So it's going to be this times 80%. Okay. And these numbers are seemingly pretty big. Just let me check. 4%, 13 mil times 4%. Okay, looks good. So depreciation here is simply going to be this, and then I can spread it across. EBT is going to be EBITDA plus the depreciation in same formula. Tax expense is always applied on the pre-tax income. Here, EBIT, after EBIT, we usually have interest expense. We're assuming there's no interest expense here. So EBIT does become EBT, or the pre-tax income on which the tax is applied. So we're going to do EBIT multiplied with the tax rate, which is 25% plus -1. This gives us the tax expense. The net income happens to be EBIT plus the tax expense. So this is our net income. Change in net working capital. Now we got to calculate change in net working capital. For 2020 baseline year, it's given as 300,000. Okay, for base year, it's given as 300,000. But in the future, it's going to be 2% of the change in sales. It's going to be 2% of the change in sales. So we got to do, open the parentheses. We're going to do look at the sale, the revenue for 2025 minus the revenue for 2024 multiplied with 2%. Okay, that's the change in net working capital going forward. Okay, so we calculate all the variables that we need to calculate the free cash flow. The free cash flow formula is EBIT into 1 minus tax, which is also called NOPAT. I'll create a separate video explaining FCFF, FCFE in more detail, but we're just going to work with this formula on this video. So for those who already know how the formulas are derived and what it means, again, FCFF is the money that belongs to both debt and equity holders. EBIT represents the money that belongs to both of these capital providers. That's our starting point. So we're going to go down and fill out the rest of the model. The WACC, weighted average cost of capital, is 10%, and the terminal growth rate, which I've linked with this cell, is already given to us as 3%. Okay, so our estimates of free cash flow are going to be this. Okay, we're going to start with year one free cash flow calculation. I'm going to leave the base year out. We don't include that in our enterprise value calculation. Since EBIT into 1 minus tax, since interest was 0, EBIT becomes EBT. EBT into 1 minus tax is net income. So I can simply just use net income plus depreciation. But since depreciation is denoted with the negative sign, and I want to add it back, I'm going to do minus depreciation. Then I'm going to do plus capex, although I don't want to do minus capex because capex is denoted with a negative sign. I'm going to do plus because this is EBIT into 1 minus tax plus NCC, which could be Depreciation and amortization are the two examples most commonly used. Minus FCINV, which represents CapEx. It's fixed capital investment. And then we have minus working capital investment. Fixed capital investment is CapEx. And then I just gotta subtract the change in net working capital, which I calculate here. Okay, so that's my estimate of the free cash flow for year one. Similarly, we can calculate for the next 5 years. So our terminal value calculation, this is again going to be explained in more detail in upcoming lessons on free cash flow and the terminal value. Terminal value is going to provide an estimate of the growth of our company into perpetuity. Not the growth, the free cash flow into perpetuity, which we're going to then discount at the WACC to calculate the enterprise value today. Since I'm treating year 6 as the terminal year, okay, so I'm going to use the year 6 free cash flow and I'm going to divide it by WACC minus the growth rate. That's the formula for terminal value calculation. And if you are paying attention, you can see that the terminal value gets calculated in year 5. Why does it get calculated in year 5? Because it always gives us the answer 1 year before. Okay, and then I'm just going to total cash flow. I'm just going to sum up these two numbers. Although there's nothing here, I still like to use this formula so that I have the total cash flows in one line. As you can see, like in year 5, we have the free cash flow for year 5, which we're going to add it up with the terminal value calculation. We're going to ignore year 6 because the terminal value in year 5 represents all the free cash flows from year 6 to infinity. So we don't need year 6 free cash flow. The discounted cash flow formula I'm going to use is going to be this divided by open parentheses 1 plus WACC. I'm going to like hard code the WACC formula here to the power of 1. Again, I'm going to spread this across here. And that's going to be the discount cash flow for all these years. Enterprise value is just the sum of all these DCF values. So our enterprise value is 67,89204. There is another method that I showed you that's again in one of my previous videos. I've shown this formula, which is an NPV, which you can use as a shortcut of instead of having to do all this DCF manually, where we can do NPV is going to be the WACC, which is the discount rate, and then we look at the total cash flows, and it should give us the same value, which it does. Okay, now let's go to the case study. The debt is provided to us as 6 million. I'm just going to type that in. Cash is provided to us as 2 million. That's 200,000. One more zero. Oops. So net debt is the debt minus cash. Okay. So our equity value then becomes. So another formula for enterprise value is equity value or the market cap plus the market value of debt minus cash. Debt minus cash is net debt. So we can say that the enterprise value is the equity value plus net debt. You take the net debt to the left-hand side, then that becomes enterprise value minus net debt gives us the equity value. So that's what we're going to do. Enterprise value minus the net debt. Okay, and now simply the shares outstanding are 1 million. So our equity value per share is going to be, okay, this is a very comprehensive model that we've created. And this is how you can do case studies on free cash flow to the firm. I can create more examples. If anyone is interested in doing or replicating this sort of analysis, please feel free to leave it in the comments and I'll send you additional case studies that I have. But this is the most extensive in terms of the free cash flow. But yeah, there's other case studies that we can do where we have to create the debt schedule, the property plant schedule, the retained earnings schedule. So there's going to be added more complexity to be added. But hope you enjoyed this video, and I'll see you in the next one.